So hi everyone, thanks for coming to our Q4 2020 recap and market update. Do free markets still exist? I'm Corey Reeder, Chief Investment Officer with HK Wealth Management. And as I mentioned, there's a lot going on out there in the world. And obviously bad news is good news is good news, no news is good news, and all the news is apparently good news as markets just keep levitating higher. But we'll dig into why this is all going on, what's happening behind the scenes. And ultimately, I think what we all know is ultimately coming down the road. So right off the bat, we're not going to spend too much time on economic data and such, because as we just said, is that no matter what comes out, everything is continually bullish for markets. But you can scan through these different headlines that I've come across here just over the last couple of weeks. For different things that are going on. Real estate, commercial real estate, collapse of equity proportions coming because of all the shutdowns of restaurants. 3 straight months of slump in restaurant and online spending. First-time jobless benefits. 900,000 Americans filed for those last week. But really, it's this last one down the bottom. So Citi chief economist Tobias Levkovich, he was quoted in one of their updates that he did that there is a 100% historical probability of down markets in the next 12 months from current levels. Now, why would he say such a thing? This is why. So this is from Citi Research. This is their panic euphoria model. And you'll see that, this was the dot-com area in 2000 when you had the euphoria going on. But as of today, this has literally gone off the charts. This is why Citi is saying that over the next 12 months, there's a 100% likelihood that investors will lose money because things are just way too bullish to the nth degree and to the extremes, and there will be adjustments from these distorted levels. And to give you some examples of what these distorted levels look like. So this chart is the IWM. This is an ETF. It represents the Russell 2000 index. So this is your small cap index. But looking at what went on from late 2018 into 2019, 2020, but this was the crash in 2020. This was what happened in December of 2019. But you'll see what's happened since then. Small caps have absolutely exploded off into the stratosphere, and you'll see even on the momentum index down here how much higher today's level is compared to anything historical going all the way back to 2001. But to put it in perspective, so your price to earnings multiples, you'll hear this talked about in Wall Street a lot, that there's going to be a multiple expansion, which just means that stock prices are going higher for no good reason. Now, back in 2008, the P/E multiple, so the price to earnings, so the price of the stock was so many times the earnings of the underlying companies. Now, back in 2008, that multiple was 8. That was very low for historical standards. Normal range is 15 to 16 times. 25 is looked at as very expensive, but today small cap stocks are sitting at 85 times earnings. I mean, this is just phenomenal what is going on, and the absolute disregard for anything economic, anything reality-based or fundamental-based. And so this is just one example within small caps of what's going on out there. But, we can look at the total market, the total size of the market. So this is your total market cap to GDP ratio. So what this is looking at is the total size of the stock market compared to the actual economy, the size of the economy. Now, looking back at 2000, and we all know what a bubble that was, and everyone still talks about it, but the size of the stock market only got to about 143% of the underlying economy. Where do we stand today? The green line. We're at 193%, almost 200%. So we are more than 2 times the size of the bubble from 2000. That's the size of the bubble that we're in today. But if you want to look at it as a direct comparative of what the actual stock market, this one's looking at the Wilshire total market index. This is including all market caps and various sizes out there. It's not just the S&P or the Dow or such. But when looking at this chart, you'll see that this is just continually bounced and ricocheted and moved on higher. The green line is your GDP. So this was the crash that we had in March, but you'll notice the GDP rebounded and then has turned and flatlined. Well, the economy isn't continuing to grow. So what's pushing these market prices ever higher? When you look at the red line, this is the total assets of the Fed. So this is the Federal Reserve going back to 2008 when they started doing all their quantitative easing and stimulus, adding assets to their balance sheets. So this right here is what is accounting for this extension in markets, because it's not economically based, as you can clearly see. So when talking about liquidity, when you put a comparative market to global liquidity chart together, this is what you get. And this is only looking at the 2015 through to the end of 2020. But global liquidity, this is including all central banks out there. So this is the Bank of Japan, Bank of Canada, Chinese Central Bank, European Central Bank, and the Federal Reserve here in the US, all added up together compared to the World Market Index. But do you seem to see a little bit of a correlation between the two? Now, of course, Jerome Powell wants to say that they never see any bubbles in the markets and they don't see any correlation between central bank actions and what's going on in the markets themselves. But any layperson can see the clear parallel and direct hand-on-hand influence that one is having on the other. So, and looking at what the global central banks have done. So back in 2008, remember, this was the great financial crisis, as they called it. This almost ended the entire global financial system. And to save the world, central banks jumped in with $3.1 trillion to save the global economy. And now you've seen all the additional stimulus measures that they've done over this period of time. In response to March of 2020, global central banks have added $9.2 trillion. Now, this should be a warning signal to anyone out there. When you consider that 3.1 trillion saved the global financial system from destruction, what is it that we're not being told? Why is there a need for $9.2 trillion, 3 times the size of 2008, to be pumped into the markets? And it's because it's a massive financial bubble out there, that's totally connected from, any economic fundamentals or realities, and it's that way on a global basis. So this should be an eye-opener for everyone out there to understand that there's a lot more going on behind the scenes and below the surface than meets the eye, because they are really bullying up the financial system to try and offset what's going on behind the scenes. So everyone likes to talk about bubbles. And of course, the first one that Wall Street wants to pinpoint on is Bitcoin. So the BTC chart, and for obvious reasons, why? This was the bubble that occurred in 2017, and then it collapsed because anything that goes parabolically vertical is completely unsustainable and does not plateau at higher levels. So no, it's not different this time. It never is different this time, no matter when you hear someone say those words. But Bitcoin ran up to spike, and of course, Wall Street's calling this a bubble. Well, what do they say about Tesla? Oh, I'm sorry, not Tesla. This is actually Cisco from the year 2000. It ran up into a vertical bubble, and we all know what happened after the dot-com crash when the NASDAQ lost 2/3 of its total value as this whole euphoric bubble came crashing down again. There's Tesla. Take a look at the formation, how long this took to build, even for Cisco to build into the bubble. You look at Tesla, this is literally 1 year that it was doing nothing up until this point at the end of 2019, and it's literally gone vertical from, say $50 a share up to 800. I mean, I don't know how many thousands of % increase that is, but it's just ridiculous what's been going on in Tesla. And of course, right up about here was when Standard & Poor's decided in their infinite wisdom to add Tesla to the S&P 500 index. So Now, from the other side of the spectrum, think about how much pain will be inflicted on the S&P 500 index, not if, but when this Tesla bubble comes crashing down, just like Cisco and the dot-com bubble did 2 decades ago. But to put Tesla in perspective to the other auto companies out there, Tesla is now the world's most valuable automaker at $183 billion. But they only sold about 500,000 cars, I believe, thereabouts. Meanwhile, Toyota sold 22.5 million. And yet somehow Tesla is a more valuable company than Toyota, 500,000 versus 22.5 million of total, products sold. So looking at not just Tesla or a microcosm of one stock here or one stock there, looking at the NASDAQ 100 index, this was the dot-com bubble that occurred back in 1999 to 2000. You'll see this is what's happened up till today, but don't just notice how this has been climbing. Look at how, basically the brakes came off and things just skyrocketed higher. So this is NASDAQ, and this has been pulling the S&P higher as well. Dot-com bubble, 2007 bubble, and then this is where we are today. We're going to get into how and why the S&P is as high as it is today in a minute. But you're seeing that the same effect is not just happening in individual stocks, it's happening on broad-based market indexes. So, Bank of America put out this comparative study of history of asset bubbles over the last 40 years. Of course, tech, US housing, you got gold, the Nikkei back in '89, that Japan is still, I don't believe they still haven't recovered from that 30 plus years later, but they're calling this the disruptors bubble. And you'll see how much bigger it is than any other bubble, at least over the last 40 years, that has occurred in the markets here in the US. And you've got to remember as well, from the crash in March and all the stimulus and quantitative easing that the central bankers pumped into the markets, this all occurred during a recession. This is the first time in history that the Federal Reserve has managed to blow a massive bubble inside a recession. So, I guess there's a first time for everything, and they're proving it right now, but there is so much going on out there that shouldn't be. And ultimately, you talk about distortions, you talk about anomalies. Well, distortions and anomalies are a normal. They will connect back to normalcy at some point, and there will be a reversion to the mean or return to the average. That's how nature works, and that's how markets work. The laws of economics 101 always win out in the end. So the bottom line, the Fed, which set off to fight inequality, has failed tremendously because even as B of A admits, the pandemic worsened inequality in 2020. I'm sure you guys have all seen the charts that show the disconnect between the haves and the have-nots out there, and it's at historic levels. But this is showing that the value of financial assets, which is Wall Street, relative to the economy, which is Main Street, has hit an all-time high of 6.3 times. But this isn't just a recent phenomenon. This has been going on since the late 90s, when the Fed unshackled themselves and really started to blow these financial bubbles of the dot-com era, the 2007 era, up to where we are today. So yeah, that first one, the Euphoria Index, isn't the only one that's starting to go off the charts, as we've almost hit the 6.5 level on this one. So with all this going on and all the liquidity flowing around, there has been a massive increase, and I'm sure you've all seen the stories of the Robinhood traders and 12-year-olds doing YouTube videos and giving their secret trading techniques to anyone who will listen as to how to make money in the stock market. But you'll see this explosion of retail, E-Trade broker trades that have gone on a year-over-year basis. And what this has led into is, what this chart is showing is a dumb money confidence index. So understand that Wall Street has these nice little terms for people. They call your institutional players and your big boys in the markets, they're the smart money players, because they move around trillions of dollars and billions of dollars worth of assets. Your dumb money that's what they refer to as your retail investors. You know, your average Joe out there on the street who does their own trading. But what you're seeing here, back in February, you saw that retail confidence got to a new record level at this high right here, and then everything fell apart. And then, of course, things bounced back very quickly, but you'll see we're now hitting a new all-time high of investor confidence. And when there's an old saying on Wall Street, when everyone's loaded to one side of the boat, the opposite thing tends to happen, because markets are geared to inflict the maximum amount of pain on the most people possible. And you see that happening time and time again when these movements or adjustments of sentiment move so far to one extreme or the other. Moving on, once again, all these day traders and these e-brokers have been spending a majority of their stimmy checks, as they call them, these stimulus checks, not just buying penny stocks and stuff, but playing in the options markets. And this is the option speculation index, and you'll see the long-term historical trend of this. And then you'll see what's been happening since, once again, the February high. We hit new record all-time highs, and it all came crashing down up to where we stand today. So this is, once again, totally reflecting that Euphoria Index that we looked at before, but you're starting to understand that it's not just one thing. This is being, backed up and occurring again and again in different sections and different parts of the markets. And then this is once again, this is an options arena, but this is showing your total put to call ratio within the options space itself. And you'll see that, over the long term here from 2016, this ratio has over a longer term continued to decline until each time we've had these sell-offs, then you've had the adjustments to the other end. But February, we hit a triple bottom right here, and things collapsed. But look where this has gone to since then. So, there will be, as these options are unwound and moves in the other direction, you will have an adjustment in markets coming down as well. It's just how the two interplay with each other. When you hit extreme levels, records are records for a reason. And that's because you don't see those levels again for a very long time. It's just a matter of when that turning point finally hits is always the big question. So all of this is being, we already know it's the central banks that are controlling all this and pushing it all around, but understand that the blue line, this is showing the US, and the red line is showing the world, but this is your financial conditions index. And right now, we are in the most accommodative financial conditions on record, or the easiest as far as free money sloshing around in the system. We're in the easiest period of time ever on the history of this recorded track record. And this is what the central banks are doing. Even though they say that, the central bank's mandate is to help the economy and help the unemployed and the little guy and everything, where's their money always end up? In the stock market. And you got to understand, remember as well, that central bankers, they are not elected officials. They are individually hand-picked people that are put on these boards, and not to mention they have their own hundreds of millions of dollars of personal wealth in the stock market. So do you think there might be a little bit of a conflict of interest of where they are directing the monies to go to in supporting the stock markets as opposed to the real economy? But what do I know? So with all this, to look at the breakdown within the markets itself and the comparison of where the majority of the gains have gone to, this is looking at your FANG stocks. So this is Facebook, Apple, Amazon, Netflix, Google, and Microsoft versus the S&P 500 index. And we're only looking back to 2013. But what you'll see is that this has been, over this long-term trend, this has been a tech story, and each one of these moves in tech is becoming more extreme and more extreme for a total 500% gain over this period of time, over what's that, 7-8 years. Now, during the same time frame, the S&P with these FANG stocks included is only up 110%. Now, looking at the S&P without the FANG stocks, and this is through a midpoint here in 2020. This doesn't extend to 2021, but still, you see the discrepancy of, without the FANG stocks, it's only, the other, 494 stocks are only up 70% over this 8-year period compared to what tech's done over this period. So this is just a handful of stocks that's pushing things higher, to the extent that back in 2000, your 5 big technology names, Microsoft, GE, Cisco, Intel, Walmart, those 5 big names together made up a total of about 18.5% of the S&P 500's performance gains. Recently here in 2020, the top 5 companies in the S&P represented a breathtaking 25% of the entire index. 5 companies made up 1/4 of all the performance in the S&P. So I guess that means when you have 5 companies that are shooting northward, that means the other 495 have to be losing money at the same time to balance out and have some sort of a, get us to the end point of where the performance numbers are. I know that's not the exact case, because we see here without the tech stocks, they're still up 70%, but you understand the sentiment. So yeah, this is, compared to what it is that's driving these markets higher, it's all about tech. But what's even better than tech? It's non-profitable tech stocks. So let's step away. Let's forget about those silly companies that actually turn a profit and make a revenue and have some sort of a semblance of a reason for being anywhere near where they are in their price structure. Looking at this index, and finally, this is just funny stuff, as it says, Bloomberg's David Wilson notes that earnings have been anything but a prerequisite for US technology stocks to surge in the past 10 months. Down below, this is showing a Goldman Sachs index of unprofitable companies. And this gauge has increased almost 5-fold from a record low on March 18th through last Wednesday. So forget about companies that make money. If you really want to make profits in the stock market, obviously you've got to find the most beaten down, out of favor, non-profitable, money-losing company that you possibly can, and that's how you make money in the stock market. This is what your e-traders and your 12-year-olds on YouTube are telling people to do. This is how you make money in the stock market. I guess they're the ones who are buying this stuff, because any logical, rational investor isn't buying penny stocks or buying companies that aren't turning a profit. But what do I know? I guess I'm a dinosaur. So looking at the overall S&P valuations, this is a metric of what, 5, 10, about 17 different points that are looked at. And this is put out by Bloomberg and Robert Shiller. I mean, you guys have heard of the Shiller CAPE Index, and he was the one back in 2007. Yeah, he was warning of the real estate bubble that was going on then, but he really knows his stuff. He's at Yale. But looking at this matrix, 13 of these metrics are at or beyond 100% of their historical price percentiles, and the other 4 are all above 90. So we're at record extremes once again, no matter what you want. Median price to sales, price to book. Look at any of these, price to tangible book value, price to earnings. These are all off the chart. So, reality always wins out in the end, and there always will be a reconnect to that reality. But for right now, we're distorted beyond all metrics. So what are America's corporate executives doing these days? So what this is showing is your insider or your corporate insiders who have their own personal stock holdings in their companies, their sell to buy ratio. And what you see going on right now is that they are massively selling their own personal stock holdings within their companies. Now, who would have a better understanding of what their company's long-term prospects are going to be than the people who actually run those companies? And hence, their decisions and their activities are a little telling as far as where they see and what they think their company is going to be doing moving forward. So they're jumping out with, they're getting out of the boat with both feet. And as you see, this is your S&P buyback index, and you see who are they selling all their shares to? They're selling them right back to their own company. So these corporations are buying the stock from their own corporate executives who authorize the plans to buy back their own stock and enrich themselves and get out at the top of the bubble. But maybe I'm just being a conspiracy theorist. But that's the reality of what's going on right there. So yeah, are they worried about socialism, taxes, the eat the rich mentality that's coming? Perhaps it's time to do as they do too. If they're getting out, maybe it's time for other people to lighten up the load and take some money off the table. So late last year, with all this in mind, late last year, Societe Generale came out with their own study to see what effect quantitative easing, all this stimulus and everything, has had on the markets. And what they came up with is that the S&P would be trading closer to 1800 without Fed bond buying. And in fact, without QE, and this is quote from the report, the NASDAQ should be closer to 5,000 than 11,000, while the S&P should be closer to 1,800 rather than 3,300. Now remember, this was, mid to late November when they came out with this report, and stock markets just marched higher since then. But looking at the two charts below of both the S&P and the NASDAQ, you'll see that even though with all this extra money that's been pumped in, and remember think about all the stimulus checks that have been pumped out there to people who are sitting at home watching Netflix every day and living in their parents' basements and trading stocks on the through their E-Trade brokerage accounts. All this money, these billions of dollars, have been flooding into the stock market as well. So you'll see that without all the stimulus that's been going on from the Federal Reserve, stepping back from the federal government stimulus checks and stuff, but you'll see that the NASDAQ would actually not be anywhere near its February highs if we were trading on a real basis. But of course, it's exploded out to all-time highs because of stimulus. Same thing with the S&P. This was the February high, and we'd actually be sitting down here around that 1,800 level. Now, why is this important? Because looking at that S&P, when we look at this is a chart I like to show a lot when we do these review webinars. But what you'll see is the red line is your US corporate profits, and the green line is your S&P 500 index. Now you'll see that the two tend to trade in lockstep over the historical period until, once again, the Federal Reserve started pumping these repetitive financial bubbles. But you'll see that after the dot-com bubble disconnect, it did reconnect with the underlying corporate profits. And you'll notice that the economy actually turned up and started getting better while the stock market was still collapsing until they connected again. The housing bubble hit and then everything dropped together. But where we stand today, even after that collapse in February and March, we've rebounded back to the levels where we were at the start of the year on corporate profits. But what have the stock market done? It's continued to blow out and go even higher. But look right here. If this green line was to reconnect with the red line, where we'd be at? Right around that 1,800 level on the S&P. So, this is just backing up what Societe Generale is saying. I'm sure it's a big part of what they're looking at, and hence why I show this chart a lot, because this is economic reality right here. This is the distortion and the disconnect that will be resolved at some point in the future. So the one final thing that I wanted to show you guys is that looking at this red chart above here, the bottom line is the S&P. This red chart is your yield curve. Now, I'm sure you've heard about the term yield curve before in the past, but they always say when the yield curve goes inverted, it's an ominous warning sign. But it's more so not when the yield curve goes inverted, but when it uninverts and starts heading higher is when the real impacts and the downturn of the markets and most of the losses occur. This was from the dot-com bubble. Once again, leading up, probably 2006 in the mid 2007, the yield curve went inverted and then uninverted, and all hell broke loose. And now getting up into this period, you'll see we went inverted. It became uninverted, which is part of what triggered this collapse that occurred. Now, understand that back in February and March, the market was already in a massive bubble. COVID didn't destroy the market. The fundamental structure was non-existent in the markets, and it was in a bubble, and COVID was simply the pin that came along and popped the bubble of euphoria and created the collapse that occurred. Now we've had this mother of all bubbles that's been blown, with the yield curve still rising, and everything's being distorted beyond belief. So to me, because we are so much more distorted today than we were even back in February, that when the next one hits, it's going to be, it's going to be, magnitudes worse for the next downturn and crash when it finally hits. And of course, the big question is, what could do it? It could be any number of things that come along and prick that bubble. But but just as easily, just like the dot-com crash, it could be nothing at all. It could just be under the weight of its own vertical ascent that it turns around and all those buyers suddenly become sellers. So, it's not a question of if, it's just simply a question of when that next hit comes. And you'll see that each one of these moves from January 2018, December 2018, March of 2020, each one of these moves is becoming more and more extreme in each direction. This is not indicative of stable markets. And it's very telling of just how much money the central banks are printing, trying to hold this whole financial house of cards together as we speak. So looking at how our funds have done over the longer term. So, our conservative total return income fund, now we do compare against the equal weight US market index, which is representative of what your average investor's buy and hold performance would be. But head to head, our conservative fund is beating US markets by almost 6%. Our moderate global opportunity fund is basically neck and neck with the markets, but you'll see each time we're protecting from these drawdowns and giving our clients peace of mind and alleviating the fears of the financial and emotional destruction that does and will again occur in the markets. Our US equity fund, which we started on August 1st, 2018, a year after those first two, is still beating US markets by 12.5%, avoided the losses in 2018, avoided the losses in March. And that's why we still have this beat head to head. Our international equity fund is only up by 3%, but still it's beating and a lot more stable than what's going on in US markets. But now getting into some of our specialty funds. So one of the newer funds, we started up an S&P managed fund, a precious metals fund, and a Bitcoin fund on June 1st of last year. Now we've had this massive run up that's occurred in Bitcoin, as you've all heard about and and then we've seen this drop that started to occur and this pullback. But what we're looking at here is the stock to flow chart. And what this shows, this is a snippet. It's a 2-year window of this stock to flow chart. But historically, this has been predeterminant of where the price of Bitcoin is going. And of course, it's looking at the second half of this year, Bitcoin will be reaching 100,000. And it has held true in the past, so I expect that it will continue to hold true in the future. However, I am looking for a bigger correction to come back down to get more in line with this before it turns and stabilizes and then continues its march higher. In addition, JP Morgan says that Bitcoin may hit 100,000, but such a price level would be unsustainable. That was as of January 4th, even though last year they said they see it going to 240,000. So they keep jumping back and forth on what their diagnosis is. But their JP Morgan quant, Nick, you say his last name, Panigitzoglu, he proposes a gold parity thesis. So what this means is if Bitcoin were to achieve the same total market size as gold, which is currently, this is the difference of the two in billions of dollars, then Bitcoin would have to increase to $650,000 from its current price of $24,000. The long-term stock to flow modeling chart is indicating that after we hit 100,000, the next marker will be 1 million a few years down the road. But if you have any questions about that stuff, we can have a conversation offline anytime you want. But as a result, we started our Bitcoin fund June 1st of 2020. We sold and moved to cash back here once. We got a run up, sold, and got a second move to cash to protect from losses as Bitcoin pulled back. We went to cash a third time, and just yesterday we sold and moved to cash, and Bitcoin was down another 10 or 11% today. So we'll be sitting in cash and waiting for our next buy signal in Bitcoin. But over the long term, probably with the last couple of days drop, it's probably back to maybe 180%, but it's had a really nice performance over this long term. But we'll take the growth, but we'll also want to try and mitigate losses and lock in those profits when we can on each one of our funds. Now, moving on, the dollar index. So this is a chart of the dollar index, and it has been high since 2014. It ran up and it stayed high for a long time. This is what's been the collapse that's been occurring, and the dollar has been devaluing in 2020. Now we're hitting a critical support line here. So do we bounce in it and have it take off again higher, or as the expectations are with the massive amounts of printing that the central banks are doing and the Federal Reserve, and also the federal government with all their additional $1.9 trillion, that this will just totally demoralize and crush the dollar and will break through and it'll continue to drop lower. So hence, anything that is denominated in US dollars with the dollar coming down, that makes those goods and services that much more attractive, and you get more buyers for them. So think about emerging markets. They've been benefiting a lot from the declining dollar, but more importantly, think about commodities. So, on November 1st, we started a commodities fund and we started a cannabis fund. But what you'll see on this long-term commodities chart, commodities are denominated in US dollars. And so they've been benefiting from this collapse in the dollar that's been going on. But you'll also notice it's now finally broken out of this long-term resistance level right here. So now this would be indicative that having broken this resistance that we have, even just to get back to where it was at previous highs, 77, 154, that's 100%, maybe about 160% upside just to get back to previous levels where it was in 2008. But, there's a lot of upside potential to commodities with a lot of downside potential in the US dollar. In addition, our cannabis fund. So stepping back from commodities for a second, our cannabis fund, which we started November 1st, and remember all the legalization and everything that went on with the elections from start to finish, our cannabis fund is up 63%, whereas the US markets are up 30 over that period. So cannabis has been doing great for us, as an investment model option for clients. The commodities fund that I was just talking about, we started that on November 1st as well, and it's up 20%. Now, Goldman Sachs, towards the end of last year, was looking for a bull market in commodities in 2021. So that's still the forward projection and more upside for commodities, as I was just showing you. But the reality is a bull market is dictated by a 20% increase in any investment area. So by the looks of it, we already have a bull market in commodities since November 1st up to where we are today, with more to come as we head forward. And I expect, these areas, the Bitcoin, the precious metals, the cannabis, and the commodities funds are where, the real sort of organic growth and catch-up plays are moving forward. Now, speaking of precious metals, so what this chart is showing, I showed back in December that Goldman Sachs was putting out a price target of 2,200 for gold, and it was currently trading at about 1,800. But what this is from a technical analyst and a gold trader, and what this is showing is that this is a long-term chart of gold, and this was the run up into 2011, and then this was the pullback and the sideways movement, and then the recent run up that we've had over this last couple of years. But you'll see it hit resistance right here, and it started pulling back. What he's calling for is a cup and handle. You've got the cup here, and then a handle, a shallow pullback would form, and then it would potentially turn. And upon completing this target and then breaking higher, he's calling for a potential 3,000 target for gold and precious metals in general. Gold goes up, you'll have silver, you'll have the miners, everything will move upwards as well if this occurs, if the precious metals do break out higher. but you've also got to understand that the next iteration of what the central banks, the Federal Reserve is going to do is trying to hold this bubble together. They'll come out with yield curve control. And what this is, when you guys hear talks about a reflation trade and that interest rates are going higher and everything's going to be wonderful again, interest rates cannot go higher. Think about the levels of debt for 9 of the 11 years of this so-called recovery. Corporations have been effectively borrowing money at a zero interest rate environment where they could roll their debt at zero cost. So, and then think about the US nation as a whole. From under Obama, from 2008, we went from 10 to 20 trillion in total national debt. And then under Trump, we went to 27.5 trillion or whatever it is. So think about the massive amounts of debt out there. And now think about if you layer on increasing interest rates on that debt as this debt has to be rolled and refinanced, that just totally crushes any sort of economic growth moving forward. So they cannot allow interest rates to head higher, and hence that is what yield curve control is that the Federal Reserve will step in and they will announce artificial suppression of the yield curve to maintain it and make sure rates do not go too high. And this has been going on for years in Bank of Japan, and the European Central Bank just recently launched yield spread control. It's the exact same thing, but they called it yield spread control because the yield curve control has not been very beneficial in Japan for so many years. So they're trying to give it a little name change for PR's sake. But with maintaining lower yields, this can also be very bullish for gold as well moving forward. On top of that, of course, you've also got the global negative yielding debt. So this is debt where there's actually a negative dividend or a negative return on it. Imagine if you were able to issue out debt where, sure, the investors don't pay you money to hold the debt, but you actually get a premium for selling your debt because it has a negative interest rate on it. But negative interest rates are also positive for gold as well. And this is part of this increase that we've had in precious metals of late. Sure, we're having a bit of a pullback here, but so with our precious metals fund, going back to earlier in 2020, we had a great run up in this fund, up over 40%. But then we've had a consolidation pattern that's been going on, and precious metals have been bouncing sideways. And we stick to the strategy as through thick and thin, and unfortunately it's just been getting triggered to get buy-ins, and then precious metals would drop again. But I think we're getting to a point now. We just bought back into the precious metals fund, and I think we're getting close to a point here where they're getting set for another turn and another rally higher. So we'll see how that plays out, but it's one more of the fund models that's performed well in the past, and it will perform well again. We just need to get a more consistent and continual movement within the precious metal space to really get the benefit from it, rather than getting triggered out every time that we buy in. Now, the last two funds that we have the S&P managed fund. This is just purely trading in and out of the S&P 500 index in one ETF. But we started this back on June 1st, and I've been holding off as much as I could. I've been waiting for a more substantive pullback in the S&P to give us a good entry point before we buy this fund in. So, I have no problems with sitting and waiting in cash, because we already know that the S&P is way beyond nosebleed territory of overvalued structure and situation and the price of it. So for this fund, we're simply waiting for that bigger drop, crash, plunge, whatever it may be that ends up happening, to give us a nice entry point to get the S&P fund started. And then we will be trading in under the same, trading in and out of the S&P ETF as per the same parameters that we use on all those other funds. Now, the final fund is the long short all weather fund. So this is, it's a macro-based fund. This has been looking at the bigger macroeconomic changes and structures. And specifically looking to short the markets. Now, with the US markets trudging sideways, these are broad US markets, remember, the long short fund was always also trudging sideways. But then, of course, when March hit and this collapsed, this fund took off to the moon and was up 35%, made up for all this lost time here. But then, of course, continuing to try to short a market, remember, in a macro environment, knowing that the recession was going on, yet the Fed was able to manage to blow a bubble inside the recession, which has never happened before. So you have an environment where the macro data is saying that, yeah, you should be short, but the Federal Reserve kept pushing markets higher. So this fund suffered over this longer term, but we've made some paradigm shift in how this is being handled. We are moved to more of a, the buy and sell triggers and looking to lock in upwards growth as we move forward. And we made some adjustments in the holding. So we still have an overall allocation to benefit. When that crash hits, yes, this will still skyrocket higher, but we don't have the perpetual downward force that's been on it over the longer term. And you'll also notice historically, this has done the opposite of what markets have done. However, since we made those changes, we've actually made money while the market's going higher, which is good, because if we can continue to chip away and make money while we wait for the crash to occur, and then when the crash hits, we get that bonus jump from the short exposure or structuring within the fund to benefit from the crash. So, it comes down to if you are a person that believes we're in a massive bubble and you want the opportunity to be invested short and benefit when that crash occurs, then we have that fund model as well. So, and giving reasoning for and backing up everything else that's been going on, what this is the VIX volatility chart. And you'll see that this was back in the 2007, 2008. You'll see the volatility moved higher and stayed at higher levels, and then finally blew out for that last big sell-off that occurred in September and into the end of the year in 2008. And then, of course, volatility gets suppressed back. We've had some hiccups here and there, but you see it's had this base mainline up until this beginning of January. Remember when I showed you guys the effects of the January sell-off, and then the December sell-off, and then the March sell-off, how erratic the markets have become? Well, look what's happened since January 18. Volatility's gone higher and stayed higher. And then after the crash that happened in March, yes, volatility's pulled back, but it's also stabilized at a higher level. What this means is there is still a lot of stress and a lot of structural volatility concerns within the markets. And so similar to previous periods, if this doesn't get, readjust down to long-term historical levels, then this is more indicative that we have another one of these still to come. And the gentleman that I follow, whose wife is also an analyst, who predicted this 80-point spike in VIX in the first quarter of 2020, she's looking for an upcoming even bigger spike in volatility, which, back to what I was saying, is that when the next big crash comes, I think it's going to be magnitudes worse. And if what this lady is saying is that the spike in volatility will be much worse than March, that would also indicate that the actual total stock price movement of the markets will be much worse than what happened in March as well. So everything is sort of lining up, but sorry, my daughter just ran in. But this is the reality. This is what's going on in the market. So the one final thing that I guess you could say is if all this is too hard to deal with, markets and jobs and careers, we could always just all become YouTube video stars, where Ryan Kaji, this is Ryan's Toys, he's 9 years old. He makes $29.5 million in 2020. And then Nastia, she's 6 years old, makes 18.5. My daughter watches both of these. So, if we really want to become millionaires, maybe we should just become YouTube stars and set everything else aside. So anyway, of course, that's tongue in cheek, but that wraps it up. This is all my contact information. Please feel free if you have any questions or Anything you'd like to discuss in deeper context, then feel free to reach out to me and we can talk offline. But that's everything for now. Thanks for coming, and we will see you all again soon.